Evercore, ticker EVR on the NYSE, the elite independent investment banking advisory firm advising boards and CEOs on the most consequential decisions in corporate finance, generating $3.2 billion in fee revenue as the conflict-free voice in the deal room.
Founded in 1995 in New York City, headquartered in New York, 2,400 employees, fiscal 2024 revenue of $3.22 billion, advisory revenue of $2.71 billion, up 28% year over year. Revenue per banker above $1.3 million, an industry-leading productivity benchmark.
Roger Altman, a former deputy secretary of the Treasury who had built his reputation at Lehman Brothers and Lazard, founded Evercore in 1995 with a simple premise: that boards of directors and CEOs needed an advisor with no lending relationships, no principal investments, and no competing interests in the outcome of a deal.
In 2006, Evercore went public on the NYSE, becoming the first listed independent advisory boutique and establishing the credibility milestone that confirmed the conflict-free model could operate at institutional scale. The IPO provided capital for global expansion without compromising the advisory-only model.
In 2010, Evercore expanded to London with major European M&A capability, building the cross-Atlantic advisory platform that enables European deal access. In 2011, the acquisition of ISI Group added 150-plus equity research analysts and institutional sales, giving Evercore full-service capability beyond pure advisory.
In 2015, Evercore crossed $1 billion in advisory revenue, the threshold that defined elite boutique status in the M&A advisory industry. The milestone confirmed that the independent model could compete directly with bulge bracket banks for the largest and most complex transactions.
In 2021, John Weinberg became sole CEO as the M&A market reached its peak, driving record revenue of $2.3 billion. In 2022, rising interest rates froze the deal market, compressing advisory volume and revenue from the 2021 peak through 2023.
In 2024, the M&A market recovered. Advisory revenue reached $2.71 billion, up 28% year over year, with deal fees per banker reaching a new all-time record. Total revenue of $3.22 billion represented a full recovery to above the 2021 peak on a per-banker productivity basis.
Evercore generated $3.22 billion in fiscal 2024 revenue. Investment banking advisory dominates at 84%, $2.71 billion. Investment management contributes the remaining 16% at $510 million from $10 billion plus in assets under management.
Advisory revenue grew 28% year over year. Operating margin expanded to 28.5%. Adjusted EPS grew 35% to $11.20. Revenue per banker exceeded $1.3 million, a metric that reflects Evercore's selectivity in hiring only revenue-generating senior talent rather than scaling headcount without productivity discipline.
Evercore's primary moat is the advisory-only model. 100% of revenue comes from advisory fees. No lending, no trading, no principal investment. This structural independence is the product itself. When a board needs a fairness opinion or strategic recommendation on a $10 billion deal, they cannot hire a bank whose trading desk might own the target's bonds.
The talent compensation model is the second moat. Evercore can pay senior bankers compensation tied directly to the advisory fees they generate, unconstrained by the fixed salary structures and regulatory capital requirements that limit banker pay at large banks. The highest producing bankers in M&A choose Evercore because the upside is directly proportional to their contribution.
Evercore has delivered 10 consecutive annual dividend increases. Total annual dividends paid approach $140 million. The dividend history from $1 TEPS in 2015 to $3.08 in 2024 reflects 175% growth over the decade, substantially ahead of most financial services peers.
The dividend coverage is supported by a highly variable advisory fee revenue model. In strong M&A years, Evercore generates significantly more than the dividend requires, and in weak years like 2022-2023, the company maintained the dividend through the downturn, reflecting management's confidence in the long-cycle recovery potential.
On the competitive radar, Evercore leads on advisory-only independence at 95 and M&A advisory market share at 90. Lazard leads on global expansion at 90. the most international of the independent boutiques. PJT Partners scores 92 on advisory independence, the pure restructuring advisory benchmark.
Evercore leads on research ecosystem at 85, reflecting the Evercore ISI research platform's 150-plus analysts covering companies that are Evercore advisory clients. Neither PJT at 50 nor Moelis at 45 has invested in equity research at Evercore's scale, giving Evercore a corporate access pipeline advantage in attracting advisory mandates.
Evercore maintains offices in 25-plus cities globally, anchored by New York, London, San Francisco, Houston, and Toronto. More than 150 senior managing directors generate advisory mandates. 150-plus research analysts cover equity markets. $10 billion-plus in investment management assets provides a recurring fee base.
The post-crisis governance trend reinforces Evercore's structural position. Delaware courts have consistently emphasized the importance of independent advice in major transactions, and institutional investors increasingly require boards to engage independent advisors rather than relying solely on banks with lending relationships. This regulatory tailwind is permanent.
John Weinberg holds a BA in history from Yale and an MBA from Harvard Business School. He began his career at Goldman Sachs in 1988, advancing to managing director before joining Lazard as co-head of investment banking in 2002.
Weinberg joined Evercore in 2010 as co-chairman and served as co-CEO from 2010 through 2021, building the firm's advisory market share and the Evercore ISI research integration. He became sole CEO in 2021 at the peak of the M&A boom and managed the 2022-2023 deal market drought without cutting the talent base or the dividend streak. Evercore advises boards of directors and CEOs on the most consequential decisions in corporate finance: mergers, acquisitions, and restructurings, where the stakes are too high to hand to a bank that has a lending relationship with the other side of the table. It is the independent voice in the deal room, and that independence is the entire product.
The M&A advisory business is a pure bet on deal volume. When rates fall and CEO confidence returns, Evercore's phone rings with mandates. The 2022-2023 period of rate shock and deal market paralysis compressed Evercore's revenue but didn't damage its relationships or talent base. The current recovery in advisory volume, $3.2 billion in revenue with a new all-time high in deal fees per banker, suggests the drought is ending, and Evercore's combination of elite talent and balance sheet independence puts it in a strong position for a sustained deal market recovery. Evercore reported Q1 2026 net revenue of $1.15 billion, up 95% year over year, as a surge in closed M&A transactions delivered the firm's highest quarterly advisory revenue since the 2021 deal boom. Adjusted EPS of $4.80 beat the $3.46 consensus by 38.7%. The independent advisory thesis is being rewarded in real time. Today we break it down.
Evercore was founded in 1995 by Roger Altman, a former Lehman Brothers investment banker, as an independent advisory firm focused exclusively on advising clients rather than trading or lending. Headquartered in New York, Evercore employs approximately 2,100 professionals across 20 offices globally. The firm operates two primary segments: investment banking, comprising M&A advisory, restructuring, and equity capital markets, and investment management, which encompasses wealth and asset management for high-net-worth clients.
With trailing 12-month revenues of $3.46 billion, a market cap of $8.9 billion, and roughly 74 million shares outstanding, Evercore trades at approximately 19 times forward earnings. CEO John Weinberg has led the firm as sole CEO since January 2023, following the retirement of co-CEO Ralph Schlosstein. Weinberg has positioned Evercore as the destination for marquee independent advisory mandates in the current M&A recovery cycle.
Q1 2026 net revenue of $1.15 billion beat the $870 million estimate by 32% and grew 95% year over year from $590 million in Q1 2025. That growth is nearly all advisory. Deal closings in technology, energy, and financial sponsor transactions delayed from 2024 finally transacted in Q1 at an exceptional pace.
Adjusted EPS of 480 versus the 346 estimate represents a 38.7% beat, the largest relative quarterly EPS surprise Evercore has reported since 2021. The beat reflects both the volume of advisory completions and a favorable fee mix. Large-cap cross-border deals command completion fees of $5 to $15 million each, and several closed in the quarter with above-average fee profiles.
Advisory revenue in Q1 reached $995 million, up 98% year-over-year, and above the $900 million threshold for the first time in Evercore's history. Advisory fees are recognized at deal close, not on announcement, creating a lumpy but high-visibility revenue stream once the deal pipeline converts. That conversion happened in Q1 at a rate management described as exceptional.
Operating margin expanded to 28.3% from 24.8% in Q1 2025. Operating leverage at scale is Evercore's structural advantage. Once fixed costs are covered by base advisory retainers, each additional completion fee flows through at margins above 50%. The Q1 margin expansion confirms that Evercore is operating at scale on the M&A recovery, not in early cycle mode.
Balance sheet remains pristine. Net cash of $1.4 billion, $1.82 billion in cash against only $420 million in long-term debt. The net cash position provides flexibility for share repurchases, partner compensation, and opportunistic team liftouts without balance sheet risk.
Free cash flow on a trailing 12-month basis was $920 million. Q1 buybacks totaled $120 million. The 304 annual dividend, yielding approximately 2.5%, is supported by a payout ratio below 30%, leaving the majority of FCF available for buybacks and strategic investment.
John Weinberg joined Evercore in 2016 as co-CEO alongside Ralph Schlosstein and became sole CEO in January 2023. Weinberg previously spent 20 years at Goldman Sachs and brings deep relationships with Fortune 500 boards and financial sponsors that drive Evercore's mandate flow. Under his leadership, Evercore expanded its technology and energy advisory practices and gained market share against large bank competitors in mega-cap transactions during the 2022 to 2024 deal drought.
Consensus sits at 9 buys, 4 holds, and 1 sell with an average price target of $135, roughly 14% above the current price. The distribution is heavily buy-weighted, reflecting the upgrade cycle that followed the Q1 print. 4 analysts upgraded EVR to buy in the week following results, the most single-week upgrade since the 2021 M&A boom.
Jefferies upgraded to buy with a target of 145, citing Q1 as proof that Evercore's market share gains through the 2022 to 2024 deal drought translated directly to disproportionate revenue capture when the market reopened. TD Cowen moved to outperform at 139, arguing that the 480 Q1 EPS pace implies a full-year run rate above $14, significantly above the current consensus estimate.
Bulls argue that the street is still underestimating full-year EPS power. At $11 to $12 full-year estimates, consensus implies a significant deceleration from Q1 that the current deal pipeline does not support. Several large mandates announced in Q4 2025, cross-border technology and energy infrastructure deals, are expected to close in Q2 and Q3, sustaining completion fee momentum through mid-year.
The hold camp focuses on sustainability. Advisory revenue near $1 billion in a single quarter requires sustained deal activity at 2021 peak levels. If M&A momentum fades in the second half due to regulatory scrutiny, rising credit spreads, or sponsor hesitance, Q3 and Q4 advisory revenue could revert toward $500 to $600 million, compressing full-year estimates sharply.
One consistent bull argument: Evercore's market share capture from 2022 to 2024 is structural. The firm added 240 advisory bankers during the drought years, hiring from banks that were cutting headcount. Those bankers are now revenue productive at the exact moment M&A volumes recover. The revenue per partner metric hit a record in Q1, suggesting the additions were high-quality hires.
The bull case is straightforward. This is the inflection quarter the market waited for since the rate cycle peaked. Advisory revenues converting at near billion-dollar pace, combined with bankers Evercore hired during the 2022 to 2024 drought, creates an operating leverage dynamic that has historically delivered 2 to 3 year above-market earnings cycles at boutique advisory firms.
Evercore's independent model is the structural advantage. As large universal banks face increasing scrutiny around conflicts of interest in M&A advisory, particularly in sponsor transactions, independent firms command advisory fee premiums and win mandates that mixed-model banks cannot credibly serve. Regulatory pressure on bulge bracket advisory dominance is an ongoing secular tailwind for independent boutiques.
At 19 times a $15 full-year EPS estimate, EVR is not expensive relative to the M&A cycle. If full-year EPS lands at $17 on sustained Q2 and Q3 completions, the multiple compresses toward 14 times, substantial upside, still embedded in Q and print that a cautious street has not yet repriced.
The bear case centers on lumpiness. Advisory revenue is recognized at deal close, not throughout the engagement. Q1's $995 million is exceptional. It likely captured several deals expected to close in Q4 2025, but slipped. If Q2 completions lag the Q1 pace, quarterly results could disappoint sharply relative to the elevated expectations the print created.
The compensation structure is the margin risk. Evercore pays out 58 to 62% of net revenue in compensation. In peak revenue quarters, operating leverage is visible, but if revenue moderates while compensation commitments remain, operating margins compress faster than they expanded. The margin expansion story requires sustained volume, not just episodic deal closings.
The regulatory environment presents deal risk. Increased antitrust scrutiny in the United States and European Union has extended M&A review timelines and killed high-profile transactions in 2024 and 2025. If regulators become more aggressive in reviewing deals, particularly in technology and healthcare consolidation, where Evercore has significant advisory exposure, deal timelines extend, and revenue recognition shifts into future quarters.
Finally, talent retention risk is permanent at advisory boutiques. Senior managing directors with large client relationships are highly portable. If competitors offer equity or compensation packages to lift out Evercore talent during the recovery, the revenue pipeline deteriorates faster than the market assumes. 1 or 2 senior departures can be material to the mandate backlog.
Lazard is Evercore's most direct comparable, another independent advisory firm with global M&A and restructuring practices. Lazard trades at approximately 15 times forward earnings, a discount to Evercore's 19 times, reflecting Lazard's lower revenue growth over the advisory drought years and higher exposure to restructuring, which is countercyclical and less levered to the current M&A recovery.
Moelis trades at approximately 22 times forward earnings, a premium to Evercore, reflecting higher financial sponsor concentration and the view that sponsor deal volumes will drive M&A recovery through 2027. Moelis's smaller scale limits operating cost pressures, but its revenue base is more concentrated than Evercore's diversified mandate mix.
Houlihan Lokey trades at roughly 21 times forward and PJT Partners at 25 times. Both skew toward restructuring and special situations more than Evercore's M&A focus. In the current recovering deal environment, Evercore's M&A weighting is an advantage. In a credit stress scenario that drives restructuring demand, Houlihan and PJT would outperform. The cycle favors Evercore.
The peer comparison confirms Evercore's positioning. At 19 times, the market is pricing a mid-cycle advisory recovery, not the peak cycle scenario that Q1's 95% revenue growth suggests. If M&A activity sustains above mid-cycle levels through 2026, Evercore's multiple has room to expand toward 22 times on higher earnings, where Moelis trades today.
Options activity surged post-earnings. The put-call ratio collapsed from 1.3 pre-earnings, reflecting heavy pre-quarter hedging, to 0.5 after the print. The implied 15% move priced before results was 3 times larger than the actual 5% post-earnings stock reaction, leaving a significant vol crush that rewarded option sellers.
Post-earnings net call premium built aggressively at $125 to $130 strikes, expiring in September. This positioning reflects institutional investors extending holding periods and adding exposure after the earnings reset. The put-call ratio at 0.5 is the lowest reading for Evercore in 2 years, signaling near-universal bullish positioning among active options participants.
On the insider side, 2 senior managing directors purchased a combined $180,000 of open market stock in March 2026. MD purchases at advisory boutiques are particularly informative because the MDs are the revenue. Their purchases signal direct pipeline confidence. CEO John Weinberg exercised options but retained all shares, a constructive non-sale signal ahead of the record quarter.
The buyback program repurchased $120 million in Q1 at an average price below current levels, providing an EPS tailwind for the rest of the year if share prices hold above the repurchase average. With net cash of $1.4 billion and minimal capital requirements, the buyback capacity supports continued repurchases of $200 to $300 million annually without balance sheet strain.
Evercore delivered the quarter that vindicates the independent advisory model. Nearly doubled revenue and a 39% EPS beat confirm the drought-era hires are generating returns. Whether Q1 marks peak cycle or the start of a multi-year M&A recovery is the open question.
Watch quarterly advisory revenue. If Q2 sustains above $750 million, full-year EPS exceeds $15 and valuation is cheap. If completions slow below $500 million, Q1 was a spike. Advisory completions is the single number that matters.
Everything today is for informational and entertainment purposes only, not financial advice. Do your own research and consult a qualified advisor before investing. All investments carry risk, including loss of principal.
Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. Visit chargedalpha.com. See you on the next one.
Ooh, we do. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.